Hi friends, my name is Rahul Jain. I'm a SEBI registered research analyst. Few months back, I had created this video where I talked about why it is so dangerous in 2026 if you are relying solely on one asset class, be it Indian stock market, gold, or US stock market for that matter. Diversification is the answer because it gives your portfolio much needed stability in these turbulence times. In fact, I started diversifying in the end of 2025, building my gold portfolio, building my US stock market portfolio. And if you're new to US stock market, then this video is going to help you a lot, because in this video I'm going to speak about 5 US ETFs that you must know about if you ever want to invest in US stock market. Now, whether you're already investing in US stock market or whether you have not yet invested in US stock market, this video will be for both types of investors. For this video, I have partnered with Vested platform that I started using couple of months back. My experience has been wonderful and I have no hesitation to recommend Vested platform to my viewers. The link is given in the description and in the pinned comments. With that, let me speak about 5 ETFs. Please do not skip. Go through each of these ETFs so that you understand your options. It's not a recommendation here. And if you learn about these 5 US ETFs, then you will have plenty to choose from. With that, let's get this video cracking. So the first ETF I want you to learn about is a ETF called Vanguard's Total Stock Market Index Fund ETF shares, which is ticker by VTI. So if you go onto Vested platform or any other platform for that matter, you will type in VTI and you will see an ETF coming up. Now this ETF is extremely important because it is the most diversified ETF that I could find in the US stock market. Why am I saying that? Look at this ETF. This ETF invests around approximately 100% of the investable US stock market, including large cap, mid cap, small cap and micro cap, regularly traded on 2 exchanges, NYSE and NASDAQ. Now, please understand one thing, that if you're investing in, let's say, S&P based ETFs or NASDAQ based ETFs, I hope you know the basics. If you're investing in those indices, the big difference there is that you are going slightly active there, meaning that you are choosing a particular theme. You are saying that, you know what, I want to invest in AI related or tech related stocks. That's why I'm going for a NASDAQ based ETF. If you're going for S&P 500, you're going for, let's say, large companies of US, right? Here, this particular index is giving you complete access to, let's say, 100% of the listed equities, almost 100% listed equities in US stock market. You have large cap, mid cap, small cap, micro caps, right? And also, if you look at this particular ETF, this ETF is traded almost, it is from an AUM perspective, it is at number 4. So here is a list of the highest AUM based ETFs, and this is at number 4. Okay, so this is highly traded, highly liquid ETF. It's only for those people who want to take a bet on US economy or US capital market as such. They do not want to go, active. They want to go completely 100% passive. They are betting simply on the entire US stock market. They're not picking any particular sector on a theme. That's why people invest in this particular ETF. Now this ETF, if I talk about the index first of all, which index or which benchmark it is tracking? This is the first question you should be asking whenever you're learning about any ETF. So here is the index for this particular ETF, which is CRSP US Total Market Index. What is CRSP? CRSP is a company. Just like S&P, CRSP is also a company giving you an index. What is the index? CRSP US Total Market Index. It is giving you almost 100% of the US investable equity market. Okay, now coming to some finer details of this particular ETF, right? Look at the total assets of this particular ETF, $570 billion. It's huge, as I explained. Look at the expense ratio, only 0.03%. Now just imagine, by just paying 0.03% annually, what you're able to do is you are able to get exposure to almost all the US companies listed on the US stock markets, right? This is huge. In India, we have Nifty Bs, for example, that is giving you only Nifty 50 stocks. I'm not saying it's a bad index. Please don't get me wrong. Point is that I'm giving you the expense ratio picture here because it is extremely cheap. ETFs in US are extremely cheap as compared to India because this is completely passive. It is going and looking at 2 exchanges and looking at all the companies and investing and tracking a particular index. Volume wise, huge volume, 7.89 million, means the liquidity is very high. Getting in there, getting out from the ETF, very easy. The spread cost is lower, impact cost is lower, etc. Right? Now, if I talk about the sector allocation here, you will see that IT or technology is highest at the minute, and this keeps changing. Financials, healthcare, industrials, consumer discretionary. It gives you diversification. If you're looking for diversification, then you need to go with something like these ETFs, which are tracking the entire US basket. Okay, you are not choosing anything, as I keep saying, and you can again go and have a look at the individual stocks here. If I just click on this, you will see a lot of companies here. Look, I mean, this is not like Nvidia is like at 12% or 13% weightage. Why? Because it is actually catering to the entire US stock market. See, if I just keep coming here, the number of companies here is more than like 3,000 or something, right? So this is for those people where they are betting on the entire US capital market. In terms of returns, let's quickly compare, although I don't want you to bog down with the returns, but still, if you compare VTI versus S&P 500, here are the return data you can see. Past returns do not guarantee future returns, but in general, I can conclude very simply looking at this data is that it has underperformed S&P 500. Okay, be it 10-year basis, be it 5-year basis, be it 3-year basis, be it 1-year basis, it has underperformed. Why? Because S&P 500 contains large companies. Okay, and we know that right now, top 10 or top 20 companies of US stock market has been doing really well, phenomenally well, as compared to the rest of the US stock market. Therefore, you see the returns are lower here. But as I said, this is only for those people who want to diversify and take a diversified bet when it comes to US stock market. Now, my last point on this particular ETF, if you compare this with the benchmark returns, here is the return data you will see. Extremely similar tracking of the benchmark. You see everywhere the returns are very similar. VTI, you can see the NAV here, and the benchmark, only difference will be the expense ratio, which is 0.03%. So this is first index. People who want to get really basic, completely passive, that's the ETF, that's the index you need to track. With that, let me go to ETF number 2 now. Now, the second ETF I want you to learn is a ETF called QQQ. Okay, now this ETF is slightly concentrated as compared to the first one. What do I mean by slightly concentrated? This ETF allows you to track or invest in companies which are NASDAQ 100 index based. Okay, what is NASDAQ 100 index? This index is primarily involved in top 100 companies listed on the NASDAQ exchange, which does not include financial companies. So you will not get exposure to, let's say, banks, right? Now, if you want to go and only invest in those companies which are like tech heavy, tech related, for example, Nvidia's or Amazon and things like that, then this index makes a lot of sense for you. Okay. Now, coming to this index overall AUM, if you look at the overall asset under management, $383 billion as of now, which is lower than the first one that we talked about. Okay, I think it is at number 5 overall. If you look at the ETF rankings, it is at number 5 from an asset under management perspective, right? Expense ratio of this ETF is 0.2%, 0.20%, which is on the higher side. Volume is huge. Again, liquidity wise, none of the ETFs you will find any problems. You can easily get in there, get out of the ETFs during the market hours. That's not a problem, right? Now, if I talk about the sectoral breakdown here, you are going slightly active. You are choosing a particular theme here. You're saying that I want to bet on technology companies only, right? Majority of the investments are in technology companies. So you can see the sector allocation here, right? Majority of them are IT companies. You can look at the allocation here by company as well. For example, Nvidia, Apple, etc. You won't have 3,000 companies here because it is only looking at the top 100 companies which are as part of the NASDAQ 100 index, right? Now, when it comes to returns, this is where it gets really crazy. Of course, these are all past returns, not the future returns. If you see, compare the QQQ versus S&P 500 or even the first one that I talked about, this has given huge returns. Why has it given huge returns? Because tech in the last 5 to 10 years in US have been doing phenomenally well. We all know about it. I don't need to reiterate what's happening in terms of the AI, what's happening around the technology in general as a theme. It's going up. Now, if you believe in technology, in that case, you have to go and explore ETFs that are based on NASDAQ 100 index. And I've given you one of these examples. There is a similar ETF also, which is called QQQM. Okay, so if you try QQQM, you will get another one. This one also is Invesco one. Okay, QQQM comes slightly with a lower expense ratio. Although QQQ, the one that I'm showing right now, is the most traded one. Again, it's up to you. Go and check out. Minor differences, not huge differences. Now, in terms of the benchmark performance versus QQQ, if I show you the data, here is the data. If you see the benchmark here, 2 benchmark it has considered versus the NAV or the market price. Slight difference, of course. It has given slightly lower returns than the benchmark. Why? Simply because here the expense ratio is slightly more. It is 0.20%. So you will see differences around 0.20%, 0.25%. You can see the data here, but pretty much good tracking error overall if you just park the expense ratio outside. So this is the second index that is only for people who are looking to invest in the technology side of the thing and do not want to select a particular stock, be it Microsoft, Nvidia or whatever. They don't want to choose any particular AI theme or tech stock. They want to go overall in the AI theme. Then it comes the the second one, which is your QQQ ETF. Go and explore it. I've given you the link in the description as well about Vested. On Vested, you can read about these ETFs, make yourself more knowledgeable, and depending on your style of investing or your appetite, you can go for any of these ETFs that you like. Again, timing wise also, it's important that you check the prices. You know, generally you don't pick up these ETFs when they are all-time high. You look for some corrections. You look at either SIPs. On Vested, you can also do SIPs. I started a SIP 3 months back. It's still going on weekly basis. You can do that as well. It's extremely straightforward. If you want me to show you each and every feature of how to create SIPs, then let me know in the comments. I'll be happy to show you, you know, how to transfer your amount from INR to USD. How do you do basic SIPs? I'm assuming that you all know about these basic features. These are self-explanatory. But if you don't, let me know in the comments. Would love to do it. Also, if you use my link for Vested, you're going to get $10 free from Vested when you do your first transfer. So that's a benefit that you get by using my link. With that, let's go to ETF number 3 now. The third ETF that you can learn about is an ETF called VOO. Okay, VOO. If you go and type VOO, you will find that on Vested. Now, this is the largest ETF by AUM. See the AUM here, more than $8.6 billion, right? Vanguard's S&P 500 ETF. I come back and talk about this one and look at the expense ratio, 0.03%, right? Very, very cheap. Now, this one is S&P 500 based ETF, so it does not really exclude your financials that we saw in NASDAQ 100. NASDAQ 100 doesn't give you exposure to the banks. Here, it is giving you almost 80% of US stock market if you invest in S&P 500 based ETFs. Typically, top 500 companies cover almost 80% of US stock market, but then you're not investing in, let's say, small cap or micro cap, right? So if you don't want to do that, then S&P is your index to go to, and you do not want to include financials or banks, right? So now if I look at the volume here, 24 million, this is the most traded ETF on US exchanges, right? If I talk about the sectoral breakdown, here the technology will have lesser weightage as compared to NASDAQ 100. So it is much more diversified as compared to NASDAQ 100, right? You can see the sectoral breakdown here. Again, this keeps changing, right? I'm not going to give you a lot of details about the sectoral breakdown, but there is an alternative of this particular ETF which does exactly the same job. So let me also show you. Here is a ETF called IVV. Okay, this is from iShares. Exactly the same thing here. However, there is a slight difference. What is the difference here? iShare, which is the IVV one, here at least 80% they will invest in the S&P based equities, but the remaining they might do things like, for example, futures and options and swap contracts, etc. So to me, IVV is slightly more riskier or slightly more volatile. If you compare the returns, very, very similar. So if I talk about the returns here in the last few years, let's just compare it. So let me bring the returns here so that we can just check it out. So VOO versus, so here is the VOO here, okay, VOO. You can see the data here versus, let's see, IVV, right? Very, very similar returns is what you will see in the last 10 years, for example, to 18%. To 20%, slightly higher in case of VOO. If you look at the 5 years, 66%, 5 years here, 66.37%, very, very similar. But you need to understand the basic difference. VOO and IVV, the basic difference is that in VOO, it is 100% based on S&P 500, while in case of IVV, they do some bit of, you know, futures and options as well. I've given you both the options depending on your risk appetite, depending on whether this theme works for you or not. You can decide for yourself. Now, if you compare VOO's performance versus the benchmark, you can see the data here for last 3 years, 5 years, 10 years. Very, very minor differences in the returns. Why? Because the expense ratio is really, really low. It can't get cheaper than this, I think. 0.03%, and that's what is being reflected in the returns here. Again, not a recommendation here, but I am hoping that these 3 ETFs that I've talked about so far, right? One was the total market based, and then second was the NASDAQ 100, and third one is S&P 500. These are pretty much diversified. The first one was the most diversified, and the second and third quite diversified, but not 100% diversified, right? These are the 3 options for the basic investors. Or if you want to start your investing journey in US, I would say start with index funds, ETFs that I've explained to you. Now, the next 2 that I want to talk about are slightly riskier. They are more thematic and they are for advanced investors. Let me run you through those. But so far, if you're liking this video, request you to hit the like button. Share this with your friends and family so that they can get going, at least start understanding about what's happening in terms of the US stock market, which ETFs are the options. Also, let me know in the comments a simple thank you. It motivates me and my team to see your comments and your support. With that, let's go to ETF number 4 now. Fourth ETF is an ETF called SMH, which is VanEck Semiconductor ETF. ETF, right? Of course, the risk and reward ratio is very, very high here, okay? This ETF invests in semiconductor companies that are listed in US stock market, right? So it says that the fund normally invests at least 80%, minimum 80% of its assets in securities that comprise the fund's benchmark index. Now, which is the benchmark index here? If I talk about benchmark index, it is called MVSMH, okay? This is an index here which invests in 25 largest and most liquid US stocks listed companies which are in semiconductor industry, right? Here, minimum criteria of these companies is that around 50% of the revenues must be coming from the semiconductor operations, right? So there is an index which is called MVSMH, okay? This will have 25 companies. And these 25 companies will have minimum revenue coming, 50% minimum coming from semiconductor operations. Now, out of these companies, around 80%, okay, 80% of the investment this fund will do or ETF will do is in this particular index, right? Hope you understand that point. It's not that 100% of the money they are investing in this particular index, okay? Around 80%, minimum 80% is where they are investing. In terms of the total assets, $44 billion, it's not as big as the ones that we saw earlier because these are thematic. These are more riskier. Not every investor want to invest them, right? And if you look at the expense ratio, that's why it's on the higher side, 0.35% here. And if I talk about the sectoral breakdown, completely semiconductor companies here, you can see some of these allocations which will continue to change. Companies like Nvidia, TSMC, Micron, and all these companies are there, okay? Now, if I speak about the past returns, again, past returns do not guarantee. If you look at the 10-year basis, 33%, 5-year basis, 28%, last 3 years, 50%, okay? And if you compare these with the benchmark, they are slightly lower than the benchmark because the expense ratio is on the higher side, 0.35%. But more importantly, look at the PE ratio of this particular fund, okay, 43. This is why I am saying that these are very, very risky because as of now, semiconductor industry is trading at highly premium valuations. As you can see, PE ratio is around 43. S&P, Nasdaq, they are at around 26, etc. Right? So you have to look at the valuations. There is a reason that they are getting higher valuations because semiconductor chips are in huge demand. So if you're keen about semiconductor theme, right, then you add this one into your watch list. There are a few other semiconductor ETFs. Let me know in the comments if you want me to create a dedicated video on semiconductor ETFs or AI related ETFs. Happy to bring that as my second episode, right? So this is the fourth ETF, which is very, very risky, highly volatile. The risk here is that if for whatever reason semiconductor industry crashes or the stocks crashes, then this is likely to get really hit hard. With this, let me go to ETF number 5, which is also thematic and you might not have even heard about this particular ETF. ETF number 5 is tracking a theme called space exploration and innovation. So if you are interested in space related companies, then you can go and explore two ETFs. Number one is ARKX. Okay, you can see that on my screen. And the second one, which is a similar one, is Procure Space ETF, which is UFO. The ticker is UFO, right? There are differences in both of them, but essentially they are tracking and investing in companies that are investing in space. Okay. Now here, these two ETFs are active ETFs. Okay. The previous four that I talked about, they are passive. There the fund manager is not going and picking the stocks. They are just following a particular index. Here the fund manager is actively going and picking the stocks. So these are active ETFs. These are highly risky. Okay, please understand that you are relying on an ETF manager here who is going and picking the stocks, right? Now, if I talk about this particular ETF here, so ARKX here, at least 80% of their investments are going into companies that are into the space exploration and innovation, right? AUM $726 million, much lower. Expense ratio very high because this is active style, 0.75%. Now, in terms of the returns, last 1 to 3 years have been phenomenal for these particular ETFs. Both of them, last 1 year 57% and here almost 96% for UFO, right? Again, don't get influenced by the past returns. Past returns do not guarantee future returns. Only consider and explore these ETFs if you're looking for space theme for long term. Okay. And also your price point needs to be very good. You can't buy any of these ETFs at high prices. Okay. You have to go and figure that out yourself. But if you look at the returns here, healthy returns in the last 2 to 3 years versus 5 and 10 years, no. They have not been good returns. Why? Simply because space theme is picking up right now because of lots going on in Elon Musk's company as well. So IPO is coming up and all that. So go and read about this particular theme as well if you are interested. I've given you some details here, basic details here in terms of companies, for example, Planet Labs, MDA Space. You can read about these companies a little bit. And if you're wanting to look at space related themes, then these are the two ETFs right now that I've shortlisted. I think there are a few more, but I've shortlisted these two. Go and explore these on Vested Also go and read about their fact sheet. So for example, ARKX here, I looked at their fact sheet. There is no benchmark index here, okay? They are simply comparing the returns with S&P 500 or MSCI World Index, and you can see clearly that last 1 year and 3 year have been better, but if you look at the last 5 years or since inception, then the performance has not been great because the space theme is picking up right now in the last couple of years or so, right? So that's on the fifth ETF, which is more thematic, more riskier, more volatile as compared to the previous ones. I've given you a flavor of 5 ETFs in this video, not giving you any recommendations. It really depends on your risk appetite. And also please make sure that you're not allocating a lot of money to the riskier ones, right? Which are the last 2 that I talked about. And overall portfolio allocation to US stock market, that also you need to think about. How much do you want to really invest in US stock market? Is it 10%, 5%, 20%, 30%? That's up to you. And if you don't understand what should be your allocation to US stock market, please hire a financial advisor who can look at your risk appetite and tell you what are the good options for your risk appetite, for your goals, rather than blindly going and investing in any of these ETFs. I hope you learned something new in this video. If you learned something new, let me know in the comments that Rahul, I learned this particular ETF that I was not aware of. It just tells me that, you are learning something new. I am also then enjoying your comments. With that, I'll stop this video here. If you like this video, request you to again like the video. Let me know in the comments. A simple thank you. I'm going to see you in my next video. Until then, keep rocking.